radio and TV. And today, we've got a couple of conversations. I'd like to let you know that my co-host, okay, so there is the chat is a problem again. So I will have to figure it out by the next show. So my co-host Peter Morris is with me. And today we are going to be talking about the conflicting economic signals that we're getting. And in particular, we are going to be talking about the inverted yield curve. And then if we have time, we're also going to perhaps rant a little bit about some really lousy blog posts. So if you want to, please stick around. We're going to take a short break. Okay, so I am back, and I'm going to bring Peter into the picture here. I'm getting much better at this. And what we're going to do, Peter, why don't you introduce yourself? I'll give a brief introduction of myself, and then we're going to talk about your excuses.
My excuses, okay. Well, I'm Peter Morris. I am the founder and CEO of the Greenstead Consulting Group. We're an international commercial real estate advisory firm. We work with investors and developers as well as occupiers of commercial real estate, be it retail, office, warehouse, industrial. And in addition to that, we are a commercial real estate training firm. We've just expanded our work with CBRE. We also work with people like Royal LePage Commercial and a number of other realtors all around Canada, and we're hoping to be in the U.S. in the not too distant future. And my company is Greenstead Consulting Group, and you can reach me at www.greensteadcg.com. I'll repeat this at the end, or at creleasepros.com.
And I am Howard Klein. I'm the founder and host of CRE Radio and TV. I've been an attorney for 43 years, predominantly in commercial real estate, and I am also a Nevada licensed real estate agent. So why don't we kind of move on to Peter's excuse? And because
Howard, everything's going wrong. Today is like a Monday for me. You know, first off, my car had to go into the shop, and I got that back. And when I brought it back, I realized that my hot water tank had blown up. And I have a service tech who was supposed to be here a couple of hours ago, and he advised me that he's going to arrive sometime while I'm doing this show. So I'm probably going to, well, I know I will have to pop out if he shows up and leave you on your own, Howard.
Okay. So with that being said, if you start hearing some moaning or telephone ringing, that's Peter sitting on his phone. And so as a result, we are going to start with Peter to get as much of his expert take on things. Now, if I might start out with, you know, we're hearing all this stuff about economic warnings, a possible recession, etc. And there are all kinds of indicators. And I look at this stuff. Now, Peter and I are going to be talking as lay people. We're not economists. But we've been around a while, and some of this just kind of makes sense and doesn't. We don't have a crystal ball. We do know that we will see a recession. Some places worse than others. We don't know how bad it's going to be. We don't know how long it's going to be, but we know that there's going to be a recession because we're already breaking all kinds of records in terms of an uptick in positive economy. With that being said, why don't we talk about some of the indicators of a recession? And why don't we start out with, and I had already mentioned it, we're already in a 10-year cycle of economic growth. So if nothing else, that's an indicator that we're going to be hitting a recession.
Yeah. So, Howard, I mean, that's unprecedented growth. We're now knocking on the door of 10, going on 11 years of growth In both the United States and Canada. Since 2009, the economy has grown almost without a hiccup. There hasn't been a reset, really. There was a minor one that occurred a little while back, but that was only one quarter. For a true recession, my economist friends tell me that we need to see negative growth for 2 consecutive quarters. That's the official definition of a recession. But it could be just a reset. It could be a soft landing. It could be a really hard landing. We don't know, but we do know that there's going to be something that's going to happen, and the economy isn't just going to continue to roll along. One of the other indicators of something happening in the economy that is not good news is election. Economies tend to take a pause if there is an election, and it just so happens that we have an election in Canada this year in the fall in 2019 and in the United States in 2020. So those 2 events are going to foretell possibly a change. We've also seen that in the United States, Mr. Johnson has prologued the parliament there, and the whole Brexit deal is coming to a head.
You mean the UK?
UK, yes. Sorry, what did I say? Did I say the U.S.?
Yeah,
No,
yeah.
actually
You
in
said
England.
the U.S., and now everybody's freaking out, thinking that Trump just suspended Congress.
Well, no. He may have bought the UK. He gave up on Greenland. I don't know. No, not even the UK. It's in England, because the UK also includes Scotland and Ireland. My apologies to the watchers. I think I have my hot water tank on my head, on my mind here today. So, there is that going on as well, and that's going to have some shock waves both for England and for the EU as well. So all of these things are coming together right now. We do think that there is something happening in the future. When we don't know how big, we don't know. And will it affect commercial real estate? Of course. Commercial real estate is an investment just like everything else.
Well, why don't we talk a little bit about the inversion, the yield curve inversion? Because not being an economist, I'd been hearing about it for the last few months, and I'm not really sure what an inversion, the yield curve inversion is. So I looked it up, did some research, and lo and behold, really the concept is pretty easy. At least it was for me. As you're like, oh, of course. So now I know where I'm going to invest my money.
Yeah.
Right?
Oh, good.
And
You're ahead of me.
So why don't you talk? Well, of course, it's a guessing game, but why don't you talk about what it is, the yield curve inversion?
And I'm going to go from my notes because, again, I'm not an economist myself, but a yield curve is a way to easily visualize the difference of what is happening to bonds versus credit quality and different maturity dates. So it's a graph, and it basically will give you a picture that overall, in a normal curve, you're going to see higher yields on a longer term investment than you will on a shorter term investment. And the reason for that is the longer you place money into the market, the less opportunity that you have to place it somewhere else. So you want to be compensated for that. And so this curve would normally be like a smiling face, where you're smiling up on one side of your face, and that reflects a better yield if you keep your investment in a safe investment like a bond for a longer period of time.
So, I thought I promised not to say so much. No, I'm not going to do that. I was going to catch you. We did that on another show. This is how I look at it and how I understand it. First of all, what they're talking about, generally speaking, when you hear the yield curve inversion, they're talking about treasury notes and bonds. All right. So you normally, on a 2-year treasury note, where you're looking for a short-term investment, you're looking for sooner or greater liquidity, you're going to get less interest on that short-term note. Right? On the long-term note, the government wants to hold on to the money, or whoever's selling the note or buying the note, they're looking to hold on to your money longer. As a consequence, they're offering more interest on something like that.
Yes.
Now, here's where the significance is, and it's only an indicator. If all of a sudden, and this is on an open market, these treasury notes are being sold and transferred, if all of a sudden the short-term notes are getting greater interest than the long-term notes, the indication is that investors are a little bit uncomfortable with the future prospects of the economy. So they're looking to make shorter-term investments. So it's a nebulous measure of investor sentiment.
Yeah, it's where economists have looked back in history and have said that historically we've seen an inverted curve that precedes a correction or a recession in the marketplace. And you're 100% correct, Howard. And how does this impact commercial real estate? Well, commercial real estate, the market value of commercial real estate is predicated by what we call the capitalization rate, or cap rate for short. And there is a correlation, generally speaking, between the government bond rates and the cap rates. Because if you can put your money into a bond and it's very, very safe, you want in a more risky investment, and real estate is, as compared to bonds, more risky. It's not the riskiest thing you could do, but it is more risky than a bond. So if bond rates tend to move down, cap rates tend to move down. If bond rates move up, they tend to move up as well. And it only moves, by the way, when the differential between the cap rate on an asset or a class of assets and the bond rate gets a little too squishy. Just that, by the way, Howard, is a technical term, squishy. So when it gets into a range that investors feel is a little too close for comfort, then we start to see those go up. And I think what we're looking at possibly is a cap rate inversion as well, where cap rates will start to move up. What happens when cap rates go up? Well, that means that market values go down. And when market values go down, people can find themselves on the backside of an investment. So people are being a little cautious. Some of the investors that I talk to, for an example, are holding cash. They're opting for cash. If they're selling out in the product, they're not reinvesting it in real estate right now. They're taking the tax hit on it and waiting for what may come along, because they believe that what may come along in the future has a greater benefit than the tax hit that they're going to take today.
Yeah. So, talking about cash, why would you hold on to cash?
Well, cash is the king because the moment you invest $1, let's say I only have $1 in my pocket and I want to invest that $1, and I invest it in investment A, and investment B comes along and it's a better investment, I can't invest in that anymore. So I have lost opportunity cost. So when I'm looking at cap rates is also, they are an indicator of risk. So I want to hold cash because I think in the not too distant future, the market's going to correct in one way or another, and there are going to be some deals out there I can redeploy. And I'm just going to pick numbers off the top of my head to illustrate the point. If I sold it at a 4 cap on a piece of property, and I think that the market's going to correct and will end up with a 5 cap, if I reinvest in that 5 cap, I'm already ahead of the game by 25%, or 20%, depending on how you want to do the math. So that's why people are holding on to cash. They're saying, I want to take advantage when the opportunity arises. I can't wait to try and liquidate my asset then, because I'll also possibly end up with less money for my asset when I sell.
When you think about it, of all the things that I did wrong during our last major recession, it was not liquidating and getting cash, because as everything dove, I'm going, oh, I wish I had the cash to, and the problem is if you're over leveraged, then what happens is as everything dives, all of a sudden you have to sell. So you're selling high. Well, actually, you're selling low or
Yeah.
lower and lower and lower, and you don't have the ability to buy low. You want to be a bottom dweller.
Yeah,
I
I
mean,
mean, there's an old adage, Howard, you know it. We make money in this business when you buy right. So you buy low, sell high. Duh. I mean, everybody talks about that in stocks, investments, and everything else. So you make money when you buy, not when you sell. So the smart money wants to get out when the market is at an historic low cap rate. Or near the bottom. And then, a lot of the people that are experts do far better than I do when it comes to investments look for what they call the hockey stick. And being a Canadian, of course, I reference the hockey stick quite often. And the hockey stick is you're never going to time the top or the bottom of the market. What you want to look for is when the market starts to come back after its bottom, then jump back in.
sure.
And that's how you make money in this business. So a lot of people are holding on to cash. And Howard, don't beat yourself up. I moved to California in 2007 and bought a house in Los Angeles. So I think I did pretty poorly. Unlike some of my Canadian friends who, in Canada, the recession didn't hit as hard in 2007, 2008, 2009. And I know a lot of Canadians that poured money into, say, the Arizona marketplace or the California marketplace when the prices were low because they had still high value real estate that they could draw upon.
It's good strategy if you can do it. Why don't we move on to some of the other indicators? There's an article that I recently read written by Lauren Thomas over at CNBC. And the article is about the rich aren't spending money. And some of the comments that she had mentioned was there's a sudden pullback in spending among the wealthy, could cascade down to the rest of the economy and create a further drag on growth. High-end real estate is having its worst year since the financial crisis. I think she's referencing the residential, like in New York.
Yeah.
It's having some big problems, as well as retail. Luxury retails are struggling while discounters like Walmart and Target thrive. I thought Walmart, though, had a difficult quarter last quarter.
On a worldwide stage, they're not doing particularly well in that last quarter, I believe, if I remember my article correctly. But overall, there is a move to discount. I mean, just look at the proliferation of dollar stores.
Oh, yeah. Absolutely. Dollar stores started proliferating during the recession. All of a sudden, they can get into shopping centers who used to say ex-nay to them. And then all of a sudden, everybody was negotiating deals with them. Let me move on. She makes reference to a car auction in Pebble Beach where the most expensive cars foundered. Didn't do very well. And art auction sales in the first half of 2019 aren't doing well. These are all indicators that the rich aren't spending as much money. Now, if the rich aren't spending money, what does that mean in relation to a recession?
That's a good question. I don't know if there's a direct correlation, but don't forget the rich do have the ability, and I'm talking the super rich here, they do have the ability to have professional financial advisors. And, the people that I know that invest in commercial real estate, as I mentioned before, are holding cash. They're not spending money. I think that, these professional advisors are advising their high net wealth clients, take the cash position, hold tight, don't go and be a consumer. The economy is being driven by the middle and lower class consumer. And there's a belief that this is just going to continue to roll on, and it's perpetuated, frankly, by the governments that say, "Hey, the world's doing great." And I'm not singling out the U.S. government because we're getting the same rhetoric in Canada, and I know that it's happening elsewhere. In Britain, for an example, see, I got it right this time. Not the U.S., but in Britain, Boris Johnson said, "Hey, elect me, and life will be great, and we'll be fine after Brexit and all of that." So, you get these people that are continuing to consume. My concern is this: there's so much debt out in the marketplace, and this is relative to retail, that when it starts to go upside down, like we saw in 2008, 2009, the ATM, which is called the HELOC, isn't going to be there anymore. And so that, I think, will perpetuate this a little bit more. We're not going to get into the same situation of the funny mortgages that we saw in the last decade, but I think the underlying sentiment of people is still there, and that is going to cause a little bit of a concern as we go forward.
You won't have the HELOC, but my understanding is that people have short memories, and as a result, people have been pouring money into investments. It's been a long recovery, so people get more and more comfortable. They start investing more money, and they start getting a little sloppy with their investments. And I think that we're going to see those kind of problems. Some of the lenders probably have gotten sloppy, notwithstanding all of the restrictions and regulations and controls. I suspect that not everybody has been paying attention as they should be, particularly in the United States during this administration. So
yeah, and it's showing up in other places. Like we're looking at retail bankruptcies, for an example. I mean, we're continuing to see a pullback in retail generally. Forever 21, rumored to be near bankruptcy. They have over 800 locations, 99 with Simon alone. Is Simon going to jump in and take an equity position and bail them out a little bit? Who knows? We do know that the founder of the company has been mired in some internal things, and that's probably had an effect as well. We know that there's been some internal communication from other people that have courted other landlords with or without his knowledge or consent. Not yet 100% confirmed as to if that's true or not. We're also looking at some of the other things that are occurring with them. You know, Yahoo Finance is saying, hey, maybe it's just going to cut off the money losers and we'll start all over again. Okay, we had that discussion last week. That doesn't necessarily mean that the problem's fixed. And so we'll wait and see. We'll wait and see on that one.
Well,
and Taylor, Dress Barn.
Yeah, before you even get to that, I'd like to talk a little bit about Forever 21. One of the issues about Forever 21 is that they have really large footprints. Large footprints. That's got to be a burden. That's got to be scary to the landlords. And you know, you may be able to lop off some of the losers, which is the idea and strategy in a retail bankruptcy. But I do have some concerns whether or not they're going to be able to survive, particularly if the economy starts receding. It's another word for recession.
It starts receding, just like my hairline. My thought, Howard, is not so much if it goes down, but how long it stays down for. If you don't have a big bank account sitting behind you, and anybody that's contemplating a restructuring, for an example, obviously does not have a ton of money locked up in a vault somewhere that they can get to quickly. If it drags on for a long period of time, we've even seen modest companies go under as a result of a long, protracted downturn because they just don't have the reserves to weather it. As some of the other ones. So we'll have to watch, you know, where people are holding their cash in various retail companies. Are they sitting on a war chest to acquire? Are they sitting on a war chest to weather out a recession? Or are they still just merrily going along and just opening stores left, right, and center? ICSC just published a report saying there's going to be 512 store openings. Fantastic. I like that. But is the timing right, or is it one of these buy high, sell low scenarios? I don't know. I honestly don't know.
Yeah, we're going to get to that bankruptcy strategy as we talk about Dress Barn and Taylor, because there's a little caveat as to what's going on with that, and I'd like to, you know, at least in our outline, I've raised the question. What do you think about the strategy of the landlords actually buying into some of these failing retailers?
They're becoming vertically integrated. Some people say, no, that's a bad thing. Other people say, well, look, landlords have effectively done that through tenant improvement allowances and other financing that they've done in the leases. I know that it was rumored back in the 1980s, 90s, when 555 had West Edmonton Mall. They still have West Edmonton Mall, but there were parts of West Edmonton Mall that were struggling because as they built it out, the third phase was doing very well, but the first phase wasn't doing very well. And so there was a rumor that the parent of West Edmonton Mall, the landlord, 555, was going into retail and opening their own retail concepts in order to keep the lights on. I'm familiar with a shopping center in Whistler, British Columbia. Little strip shopping center was bought by an offshore company, had some vacancy in it, and the landlord said, yes, I'm going to open my own concepts in it and we'll be vertically integrated. So I get to control the whole stack.
Okay.
Are landlords good at retailing, though? That's the question, and yes. I'm not sure they are.
My experience has been it's a bad idea. Now, I've dealt with landlords who have bailed out, and we've done all kinds of things in order to keep something open in a shopping center, because if the anchor tenant closes, then it really kills all the other tenants. So in limited circumstances, a limited time period, I could see that. But generally speaking, landlords are not retailers. And in the case of Forever 21, you got to question what their strategy was in the first place. So I would ask whether or not the people running Forever 21 are all that smart. And so if you're going to bail them out, who are you going to get to run it? You're not going to run it yourself, so you're going to have the same guys who ran it into the ground? I don't know if I'm comfortable with that. In limited circumstances, as I said, yeah, I could see you doing that, but you better get in and out as fast as you can. I am very uncomfortable with this strategy.
But you know who's worse? Who's worse at running a retail or food service operation?
Attorneys.
Yeah, attorneys, but bankers. And before you dismiss what I'm about to say is, a lot of leases are pledged to the bank as collateral for the loans that they have, with the assumption that the bank can take over the premises and run it. And I've seen banks try to do that, and they're even worse because they kick out the management and try and put in new management, but they're bean counters.
They're bean counters. Bean counters, what they do is they work on budgets and they set the budget. As sales decrease, they don't invest. What they do is they set their budget on a decreasing formula. And so business just gets worse and worse and worse. You need a banker who is an entrepreneur who's willing to invest money. And I rarely see a bank willing to invest money to improve the establishment.
Yeah, I mean, the bank's position obviously is to hold it for a very short period of time and sell it. But given my druthers between a landlord doing that and a bank doing that, I think I would try the landlord because they are more entrepreneurial than the bank. Am I in favor of the landlord doing this? I'm not 100% sure. I've seen it done. I haven't seen a lot of success. But by the same token, look at the options that you have. If it's the bank or the landlord, I'll bet on the landlord before I bet on the bank.
Okay, I'm glad that you're a betting man. I'm not. If I were going to bet on something, I would bet against any landlord looking to buy into their tenant, unless it were for 6 months and only for the purpose to get out. But they also better look at in terms of investing. So, it's a difficult situation. Let's talk a little bit about Dress Barn and Ann Taylor. Now, this is rumors, but apparently that's TREPP, has recently picked up on the rumor. I read online that the New York Post I got some good information that the owners of Ann Taylor, I think it's the Loft and Dress Barn, have not been returning calls from their lenders about $1.5 billion worth of loans for the last month. That's not a good sign. But of course, that article was in the New York Post, which I'm not sure is particularly credible. However, today, Trepp caught on to the same thing and they announced it. Now, maybe they just simply picked up on the same information I got. So they're just repeating bad information, or maybe they've independently confirmed it. But let's talk a little bit about Ann Taylor and the Dress Barn, and in particular, one of the things that the article by the New York Post had indicated that they're not behind on their loans.
No.
All right. So they're current, but that doesn't mean a lot to me. And now we're going to get to the issue of bankruptcy strategy. What does it mean to me now? When I was general counsel and director of real estate for Allied Education, unfortunately, after some strong years, we ran into some financial issues. We had to file bankruptcy. And about 6 months prior, I was the person responsible for the payment of rents. I mean, I didn't do it, our CFO did it, but I was the person responsible for the strategy, and I knew we were heading in the wrong direction. So we had about $2 or $3 million a month worth of rents, and I just stopped paying the landlords. So we accumulated almost $20 million that we intended to use as a war chest, and we did ultimately use as a war chest, and the dumb landlords never said a word. They never said a word. Nobody ever objected until we filed bankruptcy.
Yeah, and part of it is because they want to keep the lights on. And it depends upon the timing, generally speaking, in the marketplace. But it's always better from a landlord's perspective, even if the tenant's not paying rent, to keep the lights on if you're needing that tenant to lease other space in the property.
If you're retail.
Upon the size of the tenant. Yeah, if you're a retailer, yeah.
If you're retail, not office. And there was a significant amount of our space that was office and
those
industrial.
Are landlords that just took the eye off the ball. I would have jumped all over that. The other thing is the bankruptcy laws give a lot of protection to the bankrupt or the person that is going through reorganization. They can terminate leases with nary financial hit to them. They can terminate employment contracts. They can terminate any kind of contract on very short notice. Employment contracts without severance pay. They can rejig things such as pension funds. Ask anybody that is a former Sears employee in Canada when they pulled out of Canada. It was via bankruptcy. So there were a whole bunch of issues that came up with respect to that. So yeah, there's a strategy behind that of cash preservation and getting out of agreements and playing hardball on renegotiating that if you want me to stay put, the rent isn't going to be X, it's going to be A or B, and I said that purposefully as to where it is in the alphabet, to give you an idea of what it's going to be like. Or, I know I owe my supplier this, but this is what you're going to do for me as we go forward. And it is a management strategy. I don't like it personally. I think it's a little underhanded, but it is business, and they're not doing anything illegal.
Just
maybe a little reprehensible.
Well, okay, I'm reprehensible, or call me underhanded Howie. But I've got to tell you that my experience, particularly with unsophisticated landlords who think that they're sophisticated. So the big boys like Simon, they've got their whole slew of attorneys and they know what to do. But landlords generally are a little bit reluctant to send out notices or press the tenant. But in this particular case, like Forever 21, it's probably too late with Ann Taylor and Dress Barn it may be too late. But if I'm a landlord and I'm getting a whiff of these rumors, I'm going to be moving as fast as I can to try to collect as much of that past due rent. And the point of this whole conversation is the New York Post made it a point saying, well, they're not behind in their loan payments. Well, the loan payments are secured. The rent payments probably aren't. It's free money. So if I was going to make a determination of, whether or not it's about to happen, I would be looking to the landlords where their locations are to find out, not that you could get the information, but that's the kind of information I'd want to know, because while they may be current on their secured loans, they may be like 3 months or more behind on their rent payments.
And on that note, Howard, I'm going to have to bail on you.
Okay. So there, hopefully you'll make it back. I tell you what we're going to do. Unless you get back, we're going to hold off on the rant, and I will just take this through, the indicia of a recession or not. All right, and you're no longer with us now. You've turned off your camera. So we're back to me, so there's no point in sharing this. So we lost Peter, hopefully momentarily. So if you're listening, I'm not going to be doing the rant unless Peter gets back. So we're not going to end at the moment, but let's talk a little bit about the indicia of the fact that we're not about to hit a recession. Now, understand, again, I'm talking as a layperson. And what I mean by layperson is I'm not an economist. So I can't give you the nitty-gritty detail on all of this, but it's some of the things that I'm looking at that try to help me determine whether or not we're heading into recession. One of which is I think the economy is still roaring. I mean, it is just moving really, really strong. It may be slowing down a little bit. There may be some storm clouds on the horizon, but it's still strong. It is not at this moment diving. The other thing, and Peter had mentioned some political things. There are some elections coming up. I would think, and the impression that I have gotten, is that the Trump administration is going to do everything it can to pump up the economy and make it as roaring as it can, at least up through the election. And if he makes it through the election, he's going to keep doing everything. Perhaps short-term solutions, but he's going to keep doing everything he can to keep it roaring, at least as long as he can. And that's important. And that should be of some concern to the Democrats, because if they should win in 2020, they may be inheriting a bad economy just like Obama did. If it crashes beforehand, that's one thing. If it crashes after the election and if they're about to take the presidency and Congress, then they may be they may be set up for some rough times. Let's talk a little bit about the unemployment rate. The unemployment rate is still at or near record lows. Now, that is really a good thing, generally speaking. And one of the things that I wanted to point out is there's also the other side of that coin. If you see the incredibly low unemployment rates, as we've seen, for business owners, it's really difficult to get good qualified help. And I've been seeing over the last year a real drop in the quality of employees and services provided. And I'm a little bit reluctant to blame the companies as much as I'm really blaming the economy. If you can't get good help, you're almost ready to start taking people as long as they can fog a mirror. And that becomes a problem. If you couple that with the fact that wages are going up, the minimum wage, they're talking about raising the minimum wage on the federal level. I'm not sure that that's going to get very far during this administration, but in a lot of other states, they're raising the minimum wage. My daughter, during her summer break, she's getting a master's. During the summer break, she's been working at an ice cream shop in Redmond, Washington, and getting paid $18 an hour for scooping ice cream. And the place is mobbed. So think about that. Wages are going up. Well, what does wages going up means? Well, that's going to put some downward pressure on employers. So all of a sudden, that's going to raise prices. Might cause inflation, or just businesses won't be reinvesting the money. That could be a problem. So when I look at higher wages and I look at the low unemployment rate, I generally see that as a good thing, but not if it's unchecked. And I think that this could be ultimately a series. Pendulum always swings. So it's going to swing one way, swing another. As everything starts getting better, all of a sudden there's pressure, more pressure to push everything down. So there are two sides to that coin. So I think we're not going to get to the article. I think that Peter and I are going to switch. We're going to do a special review and discussion with regard to some of these crappy, everything you needed to know about articles. And there's one in particular that I had the opportunity to read, and I became incensed about it. So while I had mentioned it a little bit on the post on the website, we're going to do a separate thing talking about it. And it has to do with real estate. And it was an article, something about everything you needed to know about commercial real estate leases in 300 words or less. And Peter and I were commenting before the show going, this would take us weeks upon weeks to be able to try to tell everybody what we know. And we don't know everything that there is to know. So we'll get to that. That'll be on a separate thing. If you have any questions or any comments, be sure to contact me at creradio.com or howard@creradio.com. And this is Howard Klein signing off. And okay, so let me switch, and we are going to now sign off. And that's a wrap. Oh, there's Frozen Peter.